Picture two people. Same city, same year, same economy. The first one works 40 hours a week, has a steady job, pays his taxes, puts a little money in savings every month. He does everything right, and after 30 years of doing everything right, he retires with enough to get by. Barely. The second person works maybe 10 hours a week, not because she's lazy, because she doesn't need to work more than that. Her money is working for her around the clock, in markets she barely monitors, in assets she bought years ago, in businesses she owns a slice of but has never set foot inside. By the time the first guy retires, she has enough to fund 3 lifetimes. Same economy, same rules, completely different outcomes. And now here's the question nobody wants to answer honestly. Is that a story about talent, about effort, about who deserved what? Or is it a story about a system that was quietly designed to do exactly what it's doing? Why this matters right now? We are living through the largest transfer of wealth in American history, and most people have no idea it's happening. Since 1989, the share of total U.S. wealth held by the top 1% has grown from around 30% to over 32%. That sounds small. It isn't. In real dollars, that shift represents tens of trillions of dollars, quietly migrating upward while wages for the bottom half of earners have grown at less than half the rate of overall economic output. The Federal Reserve publishes these numbers. They're not hidden. They're just not interesting to most people until you realize what they actually mean. What they mean is this: the economy has been growing. The country has been getting richer in aggregate, and almost all of that new wealth has gone to people who were already wealthy. That's not an opinion, that's the data. But here's what makes this genuinely fascinating rather than just depressing. It's not a conspiracy. There's no secret meeting, no villain twisting his hands together in a mahogany boardroom. The mechanism is far more boring and far more consequential than that. It's math, it's structure, and once you understand it, you cannot Assets versus income. Let's start with the most fundamental divide in modern American economic life. There are 2 ways to make money. You can sell your time, or you can own things that generate returns. Almost everyone starts out selling time. You show up, you work, you get paid. That paycheck is called earned income. And in the United States, it is taxed at the highest rates. Depending on your bracket, you might give 30, 35, even 37 cents of every dollar straight to the federal government before it ever touches your bank account. Now compare that to investment income. If you own stocks, real estate, or a business, and those assets go up in value, the gains on that wealth are taxed at a fundamentally different rate. Long-term capital gains are taxed at a maximum of 20% federally, and if you're in the right income bracket, that rate drops to 15 or 0. Think about what that means in practice. A nurse making $90,000 a year pays a higher effective federal tax rate on her income than a hedge fund manager making $9 million in investment returns. That is not a hypothetical. That is the current tax code. The famous investor Warren Buffett pointed this out himself. He noted that his secretary was paying a higher tax rate than he was. He wasn't bragging, he was expressing genuine concern. Nobody in Congress moved to fix it. But the tax rate is just one piece. The deeper issue is compounding. The math that changes everything. Here is the sentence that explains more about wealth inequality than any policy paper ever written. Money that is invested grows exponentially. Labor income grows linearly. Let's make that concrete. If you earn $50,000 a year and you get a 3% raise every year, in 30 years you're earning about $120,000 a year. That's solid growth. You've doubled your income over a career. Now take someone who invests $1 million in a diversified portfolio earning 7% annually on average, which is roughly what the S&P 500 has returned historically after inflation. In 30 years, that $1 million becomes about $7.6 million. Not because they did anything, not because they worked harder, because compounding is a geometric force, and time is its fuel. Now, double that. 10 million becomes 76 million. 100 million becomes 760 million. The more you have, the more the math works in your favor. And here's the cruel irony. The less you have, the less you can afford to let compounding work for you because you need the money for rent. The wealthy can afford to leave their money alone. The rest of us cannot. This is what the French economist Thomas Piketty called the fundamental force of divergence. His formula is almost embarrassingly simple. When the rate of return on capital is greater than the rate of economic growth, wealth concentrates at the top. When investment returns consistently outpace wage growth, the people who own assets pull away from the people who only earn wages. And in the United States, for most of the past 4 decades, that is exactly what has happened. Access and leverage. But compounding alone doesn't fully explain the gap. There's a second engine running underneath, and it's about access. When wealthy individuals or institutions want to invest or expand, they can borrow money at extraordinarily low interest rates. A major real estate developer can secure financing at 4 or 5%. A large corporation can issue bonds at 3%. Private equity firms can leverage buyouts using debt that costs less than their projected returns, pocketing the difference. That is called leverage, and it supercharges gains in ways that are simply unavailable to ordinary Americans. When you borrow, you do it for a mortgage on a house, probably at a higher rate than a corporation would pay, or for a car loan, or for a credit card charging 22% interest. The average American credit card rate in 2024 was above 21%. You are borrowing at a rate that guarantees you fall further behind. The institutional investor is borrowing at a rate that guarantees they pull further ahead. Same financial system, completely different terms. And then there's access to deals. When a promising private company is about to go public, the shares available before the IPO, the ones that multiply in value, go to institutional investors, venture capital funds, and high net worth individuals. By the time that stock hits your brokerage app, the early gains have already been captured. You are buying the thing someone else already got rich on. When exclusive real estate opportunities arise, when distressed assets go on sale after a crisis, when private equity deals are structured, the invitations go to those who already have substantial capital. The door is not locked, it's just located somewhere most people have never been and will never be invited. The hidden mechanism, financial policy. Here's where it gets genuinely uncomfortable. For the past 15 years, the Federal Reserve has pursued an extended policy of historically low interest rates. The stated goal was to stimulate economic growth after the 2008 financial crisis, to encourage borrowing and investment and spending. And it worked. The economy did recover. Unemployment came down, GDP grew, but there was a side effect that received far less attention. Low interest rates inflate the prices of assets. When bonds pay almost nothing, money flows into stocks and real estate in search of returns. When the cost of borrowing drops to near zero, real estate investors can finance larger purchases in bid-up property values. When companies can borrow cheaply, they buy back their own stock, driving share prices higher. Between 2009 and 2021, the S&P 500 rose by roughly 500%. Real estate prices in major American cities doubled and tripled. The value of financial assets exploded. Who owned those assets? The wealthy. The top 1% of Americans own more than half of all stocks. The top 10% own roughly 89%. So when the Federal Reserve pumped trillions of dollars into financial markets to rescue the economy, the primary beneficiaries were those who already owned the most. The rescue worked, and the wealth gap widened at a pace not seen since the Gilded Age. The middle class got low mortgage rates for a few years, the wealthy got generational asset appreciation. This is not an accident. It is not a conspiracy. It is the predictable, mathematical outcome of policy decisions applied to a system that was already tilted. The tilt just got steeper. The social infrastructure of wealth. There's one more layer that rarely gets discussed, and it might be the most durable of all. Wealthy families do not simply pass on money, they pass on systems, they pass on relationships, the right school, the right alumni network, the right introduction to the right fund manager. They pass on financial literacy that is genuinely sophisticated, not the kind you learn from a personal finance blog, but the kind that involves understanding tax structures, trust vehicles, estate planning strategies, and how to make capital work across generations. They pass on time to think about investments rather than scrambling to cover next month's bills, the psychological bandwidth to make long-term decisions rather than reactive ones. Research by economists Raj Chetty and Nathaniel Hendren has shown that where you grow up in America has a profound and measurable effect on your lifetime earnings, entirely independent of your individual choices or abilities. Children who grow up in high-income zip codes are exposed to networks, institutions, and expectations that compound over a lifetime in ways that are almost impossible to replicate from the outside. This is sometimes called social capital, and it functions exactly like financial capital. It grows, it compounds, it gets inherited. The child of a successful private equity partner does not just inherit money, she inherits a map of the financial world. She knows what questions to ask. She knows which doors exist. She knows who to call. That knowledge gap is worth more than most people realize, and it is extraordinarily difficult to close from the outside. The uncomfortable math. Let's zoom out and look at the numbers one more time, because the numbers are not abstract. In 2022, the top 1% of American households held approximately $32 trillion in wealth. The bottom 50%, roughly 80 million households, held approximately $3 trillion combined. That means the wealthiest 1% held more than 10 times the total wealth of the bottom half of the entire country. In 1989, that ratio was closer to 6 to 1. It has not converged. It has diverged steadily across Democratic and Republican administrations, through recessions and expansions, through tax cuts and tax increases. The macro trend has been consistent regardless of which party was in power. And here is the part that should give everyone pause. If current trends continue, we are not moving toward equilibrium. Piketty models and several others project continued divergence. The forces at work, compounding, leverage, asset appreciation, inherited networks, favorable tax treatment of capital, these are structural. They do not self-correct. They accelerate. There are countries that have managed to interrupt this cycle. Stronger labor protections, higher taxes on inherited wealth, robust public investment in education and infrastructure that creates genuine upward mobility. Nordic countries consistently outperform the United States on economic mobility, meaning a child born poor in Denmark has a statistically better chance of ending up middle class or above than a child born poor in America. The land of opportunity, measured by actual data, is not the most mobile economy in the developed world. That is a remarkable and underreported fact.